If you own silver right now, I need you to stop everything and hear me out because what just happened in the silver market isn't normal, it isn't natural, and it has a history that most people have completely forgotten about. A history that involves criminal convictions, a $920 million fine, and one of the most powerful financial institutions on the planet. I'm recording this on a day when silver holders are looking at their portfolios and asking themselves, what just happened? And I'm going to tell you exactly what happened, who benefits, and why this moment might be far more important than the headlines suggest. Before we dive in, I need you to do something for me. If you're watching this and you're not subscribed to Finance Nexus, hit that subscribe button right now. The algorithms are brutal, and the only way this information reaches people who need it is if you help push it out there. Now, let's get into the scary part. Silver just experienced its largest single-day collapse since 1980. Let that sink in. We're not talking about a bad week. We're not talking about a gradual decline. We're talking about a 32% drop in a single session. In barely 2 days, roughly $2.5 trillion in market value evaporated. That's not a correction. That's a detonation. And here's the question. Nobody in mainstream financial media wants to ask out loud, is JPMorgan involved again? Now, I know that sounds like conspiracy territory. I know some of you are already rolling your eyes. But here's the thing. This isn't speculation based on Reddit posts or anonymous tips. This is based on documented legal history. JPMorgan Chase & Company was fined $920 million by the United States Department of Justice and the Commodity Futures Trading Commission for manipulating gold and silver markets between 2008 and 2016. That case involved hundreds of thousands of spoof orders, fake bids, and offers placed specifically to move prices before being canceled. Several JPMorgan traders were criminally convicted. That's not a theory. That's a court record. So when the silver market suddenly experiences its most violent crash in over 4 decades, and when JPMorgan happens to be sitting at the center of that market, you don't need to be paranoid to ask questions. You just need to be paying attention. Let me walk you through what actually happened step by step, because the mechanics here matter more than the headlines. Before the crash, silver had gone nearly vertical. Prices had surged from around $80 per ounce back in December to over $120 per ounce at the peak. Retail investors were piling in. According to Vonda Research, investors poured a record $1 billion into silver ETFs in January alone. That's the highest inflow on record. People were excited, people were leveraged, and people were about to learn a very expensive lesson about how the silver market actually works. Here's the framework I want you to keep in your head. Most silver trading doesn't involve physical metal at all. It happens through futures contracts, through paper claims, through instruments that exist on screens but never touch an actual bar of silver. For every single ounce of real physical silver, there are hundreds of paper claims tied to it. This isn't a secret. This is how the market is structured, and this structure creates a problem. It means prices can move violently, catastrophically, even without any meaningful change in the actual physical supply of silver. The paper tail wags the physical dog. Now, who sits at the center of this paper market? JPMorgan. They're one of the largest bullion banks active on COMEX, the primary exchange where silver futures trade. And here's the detail that most people miss. JPMorgan is also one of the largest holders of both registered and eligible physical silver. That means they have influence on the paper market and access to physical delivery at the same time. They can play both sides of the table. Think about that for a second. They can push paper prices in one direction while simultaneously positioning themselves to benefit from that move in the physical market. That's not a conspiracy theory. That's a business model. Now, let me explain how the crash actually unfolded because the sequence matters. Before the crash, long positions had piled into silver. Many of these positions were leveraged, meaning traders had borrowed money to amplify their bets. When you're leveraged, you're playing with fire. A small move against you becomes a big problem fast. And when prices started rolling over, these traders didn't choose to exit. They were forced out. Here's how that works. As prices fall, margin requirements rise. That means traders suddenly need far more cash just to keep their positions open. Most of them couldn't meet those demands. Their positions were liquidated automatically, which created more selling, which pushed prices lower, which triggered more margin calls, which created more liquidations. It becomes a self-reinforcing spiral of destruction. And here's the cliffhanger you need to understand. Who benefits when this happens? Not retail traders. They're the ones getting liquidated, not hedge funds running tight margin. They're scrambling for survival. The winner is the player with the balance sheet strong enough to survive margin calls and to buy when everyone else is forced to sell. That player is JPMorgan. During the crash, COMEX delivery data shows JPMorgan issued 633 February silver contracts. Issuing contracts means being on the short side. The allegation circulating among traders is straightforward. Shorts were opened near the $120 peak and closed near the $78 area during delivery, capturing the entire downside while everyone else was being liquidated. Let me put that in plain language. If you short something at 120 and cover at 78, you just made $42 per ounce. Multiply that by the size of positions we're talking about, and you start to see why some people are asking uncomfortable questions. Now, I want to be careful here. I'm not claiming I have proof that JPMorgan orchestrated this crash. What I'm saying is that the market structure allows the largest, most capitalized players to profit enormously when volatility explodes. And when that structure intersects with a bank that has a documented, court-proven history of silver manipulation, it's not crazy to connect dots. But here's where the story gets even more interesting. Look at what happened globally during this crash. In U.S. paper markets, silver prices collapsed to around $78 to $81 per ounce. But in Shanghai, physical silver continued trading far above that level, at one point near 136 per ounce. That divergence is screaming something important. Physical demand didn't vanish. What collapsed was the paper price. This tells you the crash wasn't driven by a sudden flood of real silver supply hitting the market. It wasn't driven by miners dumping inventory. It wasn't driven by industrial users canceling orders. It was driven by paper selling under leverage stress, by margin calls cascading through the system, by positions being liquidated into a falling market. And that is exactly the type of environment where JPMorgan has benefited in the past. Now let me give you some context on JPMorgan's official position because this is where it gets really interesting. JPMorgan analyst Marko Kolanovic recently forecasted a potential 50% drop in silver prices. He attributed the surge in silver prices to speculative trading, comparing it to a meme market frenzy. Shortly after that forecast, silver experienced its sharp decline. Now, I'm not saying the forecast caused the crash, but when the largest bullion bank on COMEX publishes a bearish forecast, and then the market moves exactly in that direction, and then that same bank is positioned to benefit from the move, you have to at least acknowledge the optics. And here's the thing that should really make you pay attention. Despite being bearish on silver, JPMorgan is incredibly bullish on gold. They're predicting gold could rise by 65% to reach $8,000 per ounce by 2030. They're forecasting that by the end of this year alone, gold could climb to $6,300 per ounce. That's a 32% increase from current levels. Why the divergence? Why bearish silver and bullish gold? According to JPMorgan, the difference comes down to central bank behavior. Central banks are accumulating gold aggressively. JPMorgan estimates that central banks could purchase around 800 tons of gold in 2026 alone. But central banks aren't buying silver, at least not at anywhere near the same pace. So, while gold has massive institutional demand supporting it, silver is left to the whims of retail traders and industrial users. And here's the pattern I want you to see. If you were a massive institution that wanted to accumulate silver at lower prices, what would you do? You might talk down silver publicly, you might compare it to meme stocks, you might let the leveraged retail crowd push prices up, then watch as margin calls flush them out, then step in and buy when prices are 40% lower. I'm not saying that's what's happening. I'm saying that's what makes sense from a game theory perspective and in markets. Understanding incentives is more important than listening to public statements. Now let's talk about what this means for you because that's what actually matters. If you're a silver holder and you're watching your portfolio get crushed, I need you to understand something. The paper price and the physical reality are two different things. The paper market can do whatever it wants in the short term. It can spike, it can crash, it can swing wildly based on leverage, margin calls, and institutional positioning. But the physical supply of silver hasn't changed. The industrial demand for silver hasn't changed. The fact that silver is critical for electronics, medical equipment, water purification, and especially solar technology, that hasn't changed. Silver is consumed in ways that gold is not. When silver goes into a solar panel, it doesn't come back. When silver goes into electronics, it's often too expensive to recover. The above-ground stockpiles of silver relative to annual demand are actually quite tight compared to gold. And unlike some commodities where new supply can ramp quickly, silver production is stubborn. Most silver is produced as a byproduct of mining other metals like copper and zinc. That means even if silver prices rise, you don't instantly get a flood of new supply. So here's the question you need to ask yourself. Do you believe the long-term fundamentals for silver have changed because of a two-day crash? Or do you believe that paper market mechanics temporarily disconnected price from reality? If you believe the fundamentals are still intact, then this crash looks less like a disaster and more like a fire sale. But I want to be honest with you, that's only true if you have the stomach to hold through volatility. And this kind of volatility, 32% in a single day, is not for the faint of heart. Now let me shift gears to gold because the gold story is actually quite different right now. Gold has also experienced significant volatility recently. According to reports from India, gold prices dropped by 22,800 rupees per sovereign in just 4 days, one of the largest falls in history. Globally, gold fell from around $5,500 per ounce to $4,700 per ounce in a very short period. That's a drop of over $700. But here's the difference. Even after this drop, major institutions remain overwhelmingly bullish on gold. JPMorgan is predicting gold could reach 6,300 by year-end and 8,000 by 2030. Central banks are buying aggressively. Demand from investors and institutions remains strong. The gold market, unlike silver, has that institutional floor underneath it. When gold dips, central banks and sovereign wealth funds are there to accumulate. That buying creates a base of support that silver simply doesn't have in the same way. So, what does this mean for the gold to silver ratio? The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 50 and 60. In recent years, it has traded much higher, sometimes above 80 or 90. Right now, with gold holding up better than silver, that ratio is likely expanding. JPMorgan has indicated that since central banks are not purchasing silver as aggressively as gold, the gold to silver ratio could continue to rise in the coming weeks. They've said that even though silver has seen notable increases relative to gold in the past, it may not be able to maintain all of its gains. Now, here's how I think about this ratio, and I want you to keep this framework in your head. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. History shows that the ratio doesn't stay at extremes forever. It tends to revert toward longer-term averages. So if the ratio spikes now because silver is getting crushed while gold holds up, that actually sets up a potential opportunity for silver to outperform gold on the way back. But, and this is critical, that reversion doesn't happen on a schedule. It can take months, it can take years. And in the meantime, the ratio can go even more extreme before it snaps back. So if you're thinking about positioning between gold and silver, you need to think about time horizons. Gold is the steady hand. Gold is the asset that central banks hold. Gold is what moves with dignity. Silver is the wild card. Silver is what moves with violence. If you want stability, lean gold. If you're willing to accept volatility for the chance at bigger percentage gains, silver is the trade. But you have to be willing to hold through moves that feel absolutely brutal. Now, let me address something that I think is really important. And this is where I want to give you some independent thinking that you might not hear elsewhere. Everyone is focused on whether prices go up or down. But the bigger question is whether you trust the market structure itself, because what we just witnessed in silver is not a healthy functioning market. A 32% intraday crash driven by margin calls and paper liquidations while physical prices in Shanghai trade $50 higher. That's a broken market. And this is where I come back to JPMorgan's history. This is the same institution that ran hundreds of thousands of spoof orders over nearly a decade. This is the institution that paid nearly $1 billion in fines. This is the institution that had traders criminally convicted for market manipulation. And now they're telling you silver is overvalued and going lower while they're positioned to benefit from exactly that move. I'm not saying you should ignore their research. I'm saying you should understand their incentives. When a player that large makes a public call, you need to ask who benefits if the market listens. Now here's a cliffhanger I want you to think about. If silver's paper price can disconnect this violently from physical reality, what happens when the paper market loses credibility entirely? What happens when enough participants realize that the futures market isn't really about silver at all, but about leveraged bets that can be manipulated by the biggest players? At some point, if this continues, people may simply stop trusting paper prices. They may start demanding physical delivery. They may start pricing transactions based on physical availability rather than COMEX quotes. And if that happens, you could see the opposite of what just occurred. You could see paper prices unable to keep up with physical reality. That's a longer-term scenario, but it's not crazy. The more these violent disconnects happen, the more people lose faith in the paper market. And loss of faith, once it starts, tends to accelerate. Now, let me bring this back to practical advice because I don't want this to stay in abstract territory. If you're holding physical silver, you haven't lost anything. You still have the same ounces you had before. The paper price moved, but your metal didn't disappear. If you believe in the long-term case for silver, this is noise. Painful noise, but noise. If you're holding silver ETFs or futures, you're exposed to exactly the dynamics we just discussed. You're in the paper market. You're subject to margin calls. You're subject to liquidation cascades. You're playing a game where the biggest players have structural advantages over you. If you're holding mining stocks, you're in a different situation. Miners are leveraged to the metal price, but they're also businesses with costs, management teams, and execution risk. In a crash like this, miners often get hit even harder than the metal itself, but they can also recover faster if the metal bounces. My general thinking, and I want to be clear, this is just perspective, not advice, is that physical metal is the safest way to hold exposure to this thesis. You're not dependent on counterparties. You're not subject to margin. You're not at risk of having your position liquidated at the worst possible moment. You just have metal. If you're going to play the paper market, you need to understand that you're in the arena with lions. You're up against institutions with billion-dollar balance sheets, armies of traders, and documented willingness to bend the rules. That doesn't mean you can't win. It means you need to be very careful about position sizing and leverage. Now let me talk about what to watch going forward, because this story isn't over. First, watch the gold to silver ratio. If it spikes to extreme levels, that's historically been a setup for silver outperformance on the other side. But don't try to catch a falling knife. Wait for signs of stabilization. Second, watch physical premiums. If you start seeing dealers charging significantly above spot price for physical silver, that's telling you physical demand is strong even though paper prices are weak. That divergence is important information. Third, watch Shanghai. The fact that Shanghai silver traded at 136 while US paper was at 78 is remarkable. If that divergence persists or widens, it tells you the paper market is not reflecting physical reality. Fourth, watch central bank behavior. Gold has institutional support because central banks are buying. If any central banks start accumulating silver, that would be a game changer. I'm not expecting it, but I'm watching for it. Fifth, watch JPMorgan's positioning. COMEX data is public, though delayed. You can see how the big players are positioned. If you see JPMorgan flipping from net short to net long on silver, pay attention. That would suggest they think the downside is done. Now I want to end with a bigger picture thought because I think this moment is more significant than people realize. What happened in silver is a symptom of a larger problem. We have markets that are dominated by paper instruments, by leverage, by derivatives that dwarf the underlying physical assets. This creates a system that can move prices violently based on margin calls and liquidations rather than actual supply and demand. And that system benefits the biggest players. It benefits the institutions that can survive volatility and buy when others are forced to sell. It benefits the players with information advantages and balance sheet advantages. It does not benefit retail investors who are playing with smaller stakes and higher leverage. I'm not saying the system will collapse tomorrow. I'm saying you need to understand the game you're playing. And if you understand the game, you can make better decisions about how to position yourself. For me, that means owning physical metal as a core position. It means being very cautious about leverage. It means understanding that paper prices can disconnect from reality sometimes for extended periods. And it means watching the players who move markets, not just the prices themselves. The silver crash we just witnessed might be the buying opportunity of the decade, or it might be the first leg of a larger decline. I don't know for certain. Nobody does. But I do know that the people who will navigate this best are the ones who understand the structure, understand the players, and don't panic when volatility hits. So here's my question for you, and I want you to answer in the comments. Do you think JPMorgan is manipulating silver again? Or do you think this was just normal market mechanics? And are you buying this dip, holding what you have, or selling into weakness? Those answers tell me a lot about where this community's head is at, and they help other viewers understand they're not alone in navigating this. Keep your head, keep your positions sized appropriately. And don't let a two-day crash rewrite your entire thesis. The game is long, the players are powerful, but understanding the game is the first step to not getting played. I'll see you in the next.